Well, before we even, we're going to brush up into the topic of the Fed a little bit here, but just for some things to chew on, this is a really interesting time of the year. From today through the end of the month, this is actually the worst 10-day stretch of the year for stocks going back to 1950. It's a little bit of a spooky end to September, historically speaking. So if bears want to capitalize in a market that has just rallied up, seen volatility compress, and yet no clear technical hurdles cleared, then this may be the chance to lay on some positions. I myself am toying with the short put calendar for this week, but that's not really what I'm focused on. I'm focused on the fact that this Fed cycle means we're going to get a weaker US dollar, in part because dollar funding costs are coming down. Why do dollar funding costs come down? Because much of the developing world still has dollar denominated debt, floating rate debt. So as interest rates from the Fed come down, we see that those debt costs are easier to service. When you enter this part of the cycle, if the economy is not falling apart, easing conditions and a general rise in liquidity tends to be very good for commodity prices, which is why if you look to the Bloomberg Commodity Index, BCOM, or like something like DBC, you're beginning to see all sorts of bottoming come together. Now, if you look to any of these products, you may say to yourself, well, Chris, a lot of these are energy intensive products. And so if oil's in the tank, what are the odds that we're going to see a big commodity push higher from here? And I think that's the general consensus right now, because according to the CFTC's most recent round of positioning data that was released this past Friday, traders have basically never been less bullish on oil. Over the past 10 years, the Z-score of net long oil positioning has fallen to negative 1.67, the lowest reading over the past decade. If you were to expand that study back to the beginning of the CFTC's data series when it's modernized, which is 2011, this is the lowest Z-score then that you've seen since December 2011. So in effect, we've never seen a market that's been less bullish oil right now on the precipice of what could be a weaker dollar or at least lower interest rate cycle moving forward. And the bottoming that you're seeing in some of these commodities, well, the technicals speak for themselves. So guys, with IVRs still hanging around in the 50s here in crude and this really aggressive price action here at the lows, I myself have laid into short put spreads here in crude. And I think this is a place where we should look at it, because this is a very rare historical instance where you see this type of extreme positioning offsides in one of these futures markets. Again, the lowest amount of longs that we've seen in futures over the past decade and the weakest relative positioning since December 2011 in this oil market.
When oil rallying over the last 6 days, how do you think about that information from a contrarian point of view?
Yeah, so I'm actually flat oil here, so I'm not thinking about it as a...
It's got a good IV rank of 54. It's actually been expanding.
Yeah. I'm actually not thinking about it as a directional play here, but I am short premium in oil. I'm short the very tight strangle, the 69.70. So I'm wrapped around the at the money. I don't really know what to... I understand what Chris is saying. I'm not really a buyer. I'm not a believer that you have to get long just because the street is not long. I think they've already had their rally. It's good information to have. I like it, Chris. I think it's a good story. It doesn't impact.
You get to live.
Yeah, you get to live. I mean, it's not going to make me getting long deltas. It's a good story.
Well, it's a contrarian stance down here, and Tony, I've joked with you about this before. When I think about a short put spread, it's really like that Wedding Crashers trade. Owen Wilson runs up to the altar and he's saying, I'm not asking you to marry me. I'm just saying don't marry him. This view on crude oil down here isn't necessarily saying that we're constructive and expecting price to go back to 75. But just given how offsides the positioning is, the chances that we now see a bit of a cushion come into play as traders try to fill that void and pick a bottom, it may mean that there's an important low that's been formed down here. So I'm going to be trading off this and treating it like a low. I think that the volatility is there, that it's enough where you can justify selling some put spreads. I know your son Nick is in this trade as well right now. Tony, we were talking about it on overtime yesterday, but this is all about a wide enough berth. Right? If you're going to trade like this, given these circumstances, positioning rebuilds take weeks, months to occur. And so this may be longer than a typical 45-day cycle. I myself have been operating around that 60 days to expiry. And so time is your friend if we're trying to carve out a bottom up based on a positioning extreme in something like the energy market.
Like it? All right. What else you got? What's next?
Let's talk about what spurred volatility during the Fed hike cycle itself. Thanks to ChatGPT, I asked what 3 things, our little tasty bot here, tell me what's produced the biggest volatility spikes since March 2022. Of course, the Russia-Ukraine war comes to the top of that list in terms of being a persistent impact on volatility. 2022 was defined by a rise of volatility across the board. but it was also a good year for volatility sellers. Another volatility spike that we experienced in the Fed hike cycle era was what happened around the US debt limit and debt ceiling. That, of course, was short-lived, and I would point to the positioning in the S&P 500 back then when it was the largest net short position ever going into June 2023. Why did we rally into the summer months? People closed out those shorts. Maybe something similar is going on in oil. I digress. We can go further. We can talk about what happened more recently, of course, in August of this year. That, of course, is the biggest spike in volatility that we saw coming out of the Fed hike cycle here. And yet we learned an important lesson along the way. Volatility doesn't necessarily stick around. When you get into these zones where volatility rises into a 20 or 25, 30 VIX, it tends to be a fleeting moment in time, if only for a few days or weeks. And so while the Fed hike cycle itself brought some uncertainty and certainly some indigestion to markets over the last few years, traders who operated mechanically throughout this time actually came out pretty well. 2022's best performing strategy wasn't a momentum one. It wasn't a range trading one. It was a simple vol selling one. And so if we're heading through another turn right now, I think traders should have their playbook. They should understand that whatever the Fed may do or not do tomorrow, sit in front of your computer, have your historically tried and true systems that work during certain market conditions, and just execute along those lines, because these narratives and these stories, they're great for people like me to talk about, to create content, but ultimately they don't have that significant of a lasting impact if you're operating diligently and nimbly in markets through your typical 45 and 21-day out cycle.
We have done a lot of research on Fed moves over the last decade and over the last 19 years. The amount of mean reversion in price is, I'm reluctant to say tradable, but it's very evident. When we try to trade it, it's not easy, but it exists. That's the only way I can really explain it. Within 24 to 48 hours, there is a high likelihood of some mean reversion in price. Just because it's cyclical nature of the markets, nothing else. And because of the randomness of any Fed move, the emotion of it right away. I think the hardest thing for people to grasp about Fed activity is that everybody thinks like somebody knows something. And the reality is that until the order flow until the orders start coming in to the different exchanges and until we see what the street does, it's much more of an emotional reaction than it is anything. The only thing that I think would potentially be a surprise is if the Fed lowered by 3/4. I think that's the only thing that would be a surprise. I have a little bit of there's a part of me that thinks if they only do a quarter, that would be a surprise too. I think the expectation is 50 basis points. So like I said, I don't want to talk about the Fed, but I do want to talk about the fact that you cannot get hung up on trying to play catch up whenever the news comes out. Like you can't, if you have a position on pre-announcement and you're betting on premium decay or something like that, fine, whatever happens, happens. But if you think you're going to go in there post and do anything other than just like maybe scalp around or something, you could definitely play. I just don't think you're going to establish a post-Fed position immediately that you're going to get any kind of, you're just going to be it's going to be a crap shot. That's all. I don't think there's anything you can do in advance to prepare for it.
No, I mean, you can roll the dice, right? But these binary events, you really need to just make sure that all your ducks are squared and in a row heading into that, making sure that the beta weighted deltas of your portfolio and your theta exposure is exactly where you want it to be. And you have, I literally will write out game plans. If X happens, then Y. That way I don't let my monkey brain interfere with what I want to execute when prices move in a certain direction.
Yeah, that's fine.
Because right. And so I think people should have a strategy. And so if there are certain trades that you're looking to execute, like, if silver went to here, I would sell some calls. Well, if we get to that level, stick to your plan, right? Don't be afraid of the price action, because to get to that level that you wanted to sell at, the market would have had a rally anyway. So we just got the rally in a shorter time horizon than you anticipated. The point is, be prepared, right? Don't worry about what the Fed's going to do. Worry about what you're doing with your own P&L and the risk that's on the board, and people will survive it. But we did enter this week at maximum uncertainty, which made for such an interesting week, Tom. We had really, I was looking through the data. We hadn't gone to a meeting since 2002 where the market was priced within like 1% of 50% either way. We're not there right now. So we avoided this really calamitous what would happen type of scenario for macro folks. But in any event, 50 basis points is coming. We're there. What the Fed says next is all that matters. But traders, you can't really worry about it. The market's going to do what it wants to do tomorrow afternoon. And the time horizon matters here. If only to put on that a moment longer. I remember, I think it was the Fed meeting in January of last year that I put on a short NASDAQ position in NQ futures. And man, that was working out really well for the first 30 minutes. And I didn't close it out. And by the time the end of the session came, the position was completely flat. And it turned from a, several percent winner into completely a zero. The market whipsaws around. And the next day I found follow through, but it was a 0D option. So I was right on direction. I was wrong on time. And so I didn't make any money on it. And really, that's the way this market works out. So time is your friend here. Don't worry about the Fed.
I've only done that 1,000 times in my career, probably put on a nice trade, not covered it. I mean, I think you make your best. I think some of your best trades are trades that don't work out. Meaning you have to, like, you said it actually in your last little bleep that you did when you were in black and white, Sepatone. It was just a beautiful little rendition about how people aren't used to taking losses. You have to have losses to get ahead.
Yeah, that's fine. Yeah, just push that thing out. I want to bring up two topics that are kind of that dominate the news right now, just to get your take on it. I'm not going to even comment back because I'm not going to start a political discussion or anything like that. I'm just curious what you think. I don't want to get into specifics, but you and I have never had this conversation. So I'm just kind of setting a little groundwork. Deficit, do you care?
The economics part of me cares, but the reality is that there's been no tangible evidence that it's doing anything to America's fiscal position, even though I would prefer to see lower deficits just only to take pressure off of inflation. But it's not a needle mover for me. I'm not like going out to being like, oh, who am I going to vote for? Like, what are they going to do with the bean counters? And like, neither party cares about deficits, so to focus on it is silly.
You don't get elected taking care of deficit. You get elected spending.
No. That's someone else's problem. Why is Trump promising like no overtime tax and no tax and wait? Because when we actually have to bear the burden of this, when the CBO estimates tell us this becomes too much of a situation, he's not going to be in office. That's why politicians think so short term. They think in 2-year or 4-year election cycles. There's no incentive to build for the future beyond what they may do to get their next cushy job on K Street.
Yeah, I mean that's what non-founder CEOs do a lot too. Same thing. I mean, same thing. No attachment to history. So sure, somebody else.
And Harris does.
What are you gonna do when the kid goes to college?
Somebody else's problem. I agree.
Someone else's problem.
I have a very similar take on deficit, so I like that. So that's good. So let's talk tariffs.
I'm not a fan of tariffs. Tariffs are great for manufacturing, for service industries, for people that don't import goods from abroad. It's terrible. So for folks like us, it's just going to be bad. For folks that work in restaurants, like waiters and waitresses, it's going to be bad. It's going to be bad for basically everyone unless you're a protected industry. I think tariffs breed political artifice. I think they breed corruption over time. Eventually, everyone wants to get their hand in the trough and have their industry protected as well. But more importantly, forget what I feel about it. The data shows, if we look to the George W. Bush steel tariffs of 2002 or even Trump's tariffs around the washing machines, jobs in those industries and industries that had inputs related to those tariffs, like if you use steel in your industrial process starting after 2002, your industry lost jobs. The George W. Bush steel tariffs cost the economy about 220,000 jobs, if I recall correctly. And it just raised prices across the board. They're not effective. I'm also someone who believes in globalization, although there have been problems with it. I think that if we can get goods cheaper, then that's great. But tariffs don't solve every problem, right? Like we want to start I saw a great example this week. What would tariffs do on bananas? You want to apply a 10% tariff across the board? Can we have a banana industry here in the United States? No, we don't have the climate for it. What about coffee? We're going to put a 10% tariff across the board on things like coffee. Can we make coffee here in the U.S. to the abundance that we need it, that we consume on a daily basis? No. So now we're just hiking the prices on goods for everything, and that's going to be inflationary. So like this idea that we're going to stop inflation by putting tariffs across the board, I just can't. I'm trying to do the math. I can't. I'm really against it.
I'm exactly the same way. Even stronger. I have a couple.
Go stronger next time.
But what's the alternative? I mean,
what do you mean the alternative? The alternative is free trade. Exactly.
How do you raise income? Like, how do you get?
But there's a lot of countries, Japan, Germany.
What?
But the way tariffs are being described, right? Like, oh, all these other countries are going to pay them. No, we pay the tariff prices.
No, we pay the tariffs. Of course you do.
It comes out of our pockets as consumers, right? So everyone's saying, no, China's going to pay the tariffs. That's not true.
It's pure inflation. It's pure inflation waiting to happen. Totally agree.
But I understand using the tariffs as a cudgel, because when you look to a country like Japan, what's the tariff on, if you want to buy a Ford in Japan, what do you have to do? You pay 100% tariff. What about in Germany if you want to buy an American car? Tariffs are going to be close to 100%. So if we're going to be pro free trade, like we should get everyone else to come to the table too. So there does need to be this balancing out where trade is done in a way that doesn't hollow out our industrial base, doesn't harm our blue collar workers. And yes, while that's a valid point of view, I'd also remind everyone, the politicians telling us like, hey, China stole our jobs. They're the people who ship the jobs overseas in pursuit of higher corporate profit. So it's election season. Be careful who you believe for what reason.
What do you think? Something Vanetta brought up this morning, which is interesting. What do you think about a digital currency that is, either backed by central bank, Fed, whatever? What's your just take on just digital currency, not to replace the dollar, but just as a side-by-side vehicle? I mean, it's being thrown around right now by a consortium of large banks, by different central bankers. There's a lot on the table, working with conceptually with digital currency.
Yeah, I find the genesis of crypto to be so interesting because a lot of it was about privacy and making sure there was an alternative payment system outside of the reach of the Fed and banks and the government because of what happened in the global financial crisis, right? That said, though, I think CBDCs completely betray that perspective because it means that governments will be able to track everything you do. Not that Bitcoin and these cryptocurrencies are that easy to get away with. I mean, if you were using something like Tornado to mask your transactions, sure, it was difficult. But how many times have we seen people who are using Bitcoin to do illicit things? Ultimately, it gets traced back to them because it's stored in a public ledger, at the end of the day. So the digital currencies for me, while they may be good for helping facilitate transactions, I think about it in a bigger perspective, which is to say that one, they can't compete with MasterCard and Visa's payment network still. So two, what do these cryptocurrencies actually do? They facilitate US dollar dominance because now anyone anywhere in the world can convert their local currencies into a stable coin that's tethered to the US dollar. And so it helps improve US dollar liquidity. And it means that more people are going to have dollars in their pockets on the entire planet. So I'm for, as an American who lives in the Imperial Center, who'd like to see the dollar's reserve status not be lost during his lifetime, because quite frankly, look how the UK's done since the UK lost world reserve currency status after World War II. I think CBDCs and cryptocurrencies are wonderful because it cements the dollar. And that's why I think crypto is ultimately like a CIA or, some intelligence operation, because it's done nothing except make the dollar the centerpiece of global trade. And it's going to be increasingly difficult to dislodge it from there. And that's my Victor Jones level conspiracy about it.
I'm a little bit different than you on this, but we don't have time to get into it because I still want to bring up one more topic. But this will open up things for a future discussion about central bank and the last thing is this CFTC this morning won a case to delay the launch of election contracts, which was a suit that was brought forward by Kalshi, they actually won, and the CFTC tried to delay it. They failed with the first judge. They succeeded with the second judge to delay it just like a week or two. What do you think about election markets?
I'm all for it. I think they provide really interesting insight that necessarily can't be captured by polls. Polls themselves are static snapshots at any given moment in time. It doesn't reflect shifting opinions per se about earned media, for example, which is why, right? Like what fundamentally changed in the race between July 21st and August 21st? Kamala became the candidate, of course, but the person who she was didn't change. Her policy positions didn't change if any of them were revealed, right? Nothing changed, and yet her polling went up over time. So to say like, oh, on July 21st, Kamala is going to get crushed, which a lot of pollsters were suggesting, again, static snapshot. So Polymarket, Kalshi predicted, they fill the void by giving you real-time feedback. Anyone can place bets effectively, depending upon your jurisdiction, of course, and that allows a real-time information exchange. So I think it's fantastic. I think these things are great. If you look at their predictive power, particularly overseas, they've gotten increasingly good at nailing down the probabilities for certain candidates winning elections in France, the UK, Australia, for example. And so I think they're wonderful. Now, in terms of rekindling gambling spirits, listen, if people really want to have that conversation, if the CFTC is concerned about gambling, corrupting the American culture, what the hell are we doing with sports betting? Why is political betting markets the focus?
I actually think election markets provide more than that, in that when they get deep enough, they're actually going to provide a lot of election integrity, because we know how good free markets work. We know efficient market theory is real. They will provide a lot of integrity to the marketplace. And the other thing they'll do is football was, just using sports as an example, because you just brought it up, football was never anywhere close to the size franchise it was until they started various kinds of gamifying football through fantasy.
When they took it away from the paper sheets that we used
Yeah.
to bet on and fill out with your
When they started to
local hoodlum.
gamify football through, fantasy and through, much wider betting apps and everything else, football just exploded. We have a incredibly apathetic consumer base when it comes to elections. People just like, I don't care. If you create a marketplace for it, I can see it increasing engagement like by a significant percentage, and then also providing a lot of integrity back to the marketplace. Because right now there's a lot of people that say, it's all garbage, it's all crap, it's fake, whatever, everything, which is so untrue, but it is what perception matters. And I think that having election markets will bring engagement, and it will also bring integrity back to the election marketplace. So anyway,